Today, Indian retail investors have proven that even if they come and go, any shock that may come is now taken care of because of the shock absorbing capacity the Indian retailer has brought into Indian market.
Our finance minister Nirmala Sitharaman made this comment nearly 3 years ago. Well, is this comment true anymore in today's current market trend? Today we are going to discuss about the topic FIIs versus DIIs. Who runs the market trends? Who is more powerful and how does it impact the retail investors? Let's analyze this in today's video. So first, let's look at another comment our finance minister made on the same day.
Inflow of FDIs, which is remaining unabated, and India is the highest receiver of FDI since before COVID, and that continues during COVID, in fact continues very much significantly during COVID and subsequently also.
Well, if you look from 2010 till 2020, this statement looks to be true. But after 2020, it has been a red sign, a bloodbath. FIIs have been a negative factor for the Indian market, selling more than 7.5 lakh crores. And still, these FIIs hold more than $800 billion worth of stocks, assets in the Indian market. Well, when our finance minister was asked, why is exactly FII leaving Indian markets? Well, this is what she said.
Implying it in your question itself, that FIIs also go out when they're able to, in a position to book profits. Indian market today, Indian economy today has an environment in which investments are also yielding good returns and profit booking is also happening. And I'm sure you would have seized that fact also.
Is this true? Is that the reason why FIIs are leaving? Simply because they can just book profits? This is not true at all. Well, let's decode why are FIIs leaving. If we understand this factor, that an average return from the Indian market is near 12 to 14%. And then if we look since 2019, the Indian rupee have been depreciating 3.3% on an average every year. In 2024, when they increased the taxes of the stock market going from 10 to 12.5% and 15 to 20%. This really affected the FIIs. Why? Well, let's understand this. If FIIs invest 100 rupees for 1 year and they get a return of 113 rupees, taking an average, they will first have to pay 3.3% on the rupee depreciation. If you calculate this, you will have a round figure of 108.3 rupees. And then if we calculate tax, it would be near 1.2 to 2.5 rupees. If you deduct that from 108.3, you will be left with near 107 to 106 rupees return. And then if you calculate the exchange charges, you will be left with a return of near 104.5 to 106 rupees, which is what? A 4.5 to 6% return. Well, FIIs, after looking at these returns, will definitely exit the Indian market. Why would they want to stay in it if they're only getting 4.5 to 6% returns in the Indian market? And according to our analysis, we have also been showing you the facts why the Indian market can be overvalued and why stock markets like China, Latin America can be way cheaper than the Indian market. Well, as an investor, your goal should be to buy low and sell high. Buy in undervalued assets and get out of the overvalued assets. If you think that we are giving a political view, please keep doing that because we are really not interested. We are here to share you our analysis that can make you money and make you profitable. We shared our analysis why the Indian markets can go down, and it has went down more than 15% from when we shared our first ever analysis. Now coming back to the topic, if we look, FIIs since 2021 have sold nearly 8 lakh crores, and if we compare it with the DIIs, they have bought more than 12 lakh crores. So where are they getting this money from? Well, they're getting this money from your SIPs, from your investment in mutual funds. But if you're up to date with the market news, you will get to know that these SIPs are slowly and steadily have stopped increasing. We might even witness a reverse back, that people will exit from their SIPs. And then what can happen? These DIIs won't be left with any money to stabilize the market. Well, whenever FIIs sell, that does lead to a major effect in the Indian market. And DIIs try to stabilize it as much as they can. But if SIPs start to stop, people stop investing through mutual funds, DIIs won't be left with any money soon. And for the retail does hold a lot of power. But when these FIIs and DIIs start to have a war with each other, the only people that are being crippled are retail investors. Which is why we believe you really need to stop listening to these news channels, these equity research firms which gives recommendations on stocks, and really try and do your own analysis and gather as much as information before making any investment. So if you like this video, don't forget to like, share and subscribe, and hope you don't lose your money in the market. Thank you so much.